Did you know that many traders struggle because they can't fully understand the range and the range cycle, the liquidity cycle inside the ranges especially. And this is going to cause them to lose a lot of money in the fail breakout, the fair market shift, and the fail liquidity sweep. While professional traders, they're going to spot this opportunity and make money from it. In this video, I'm going to share 3 advanced tips about the liquidity and the range cycle, which transfer my trading journey from a dropout high school trader to a trader, professional, profitable trader that earning 5-figure per month from trading. And trust me, this is not a recycled information. These are the information that I actually personally use in my trading analysis and my trades. So let's kick things off with the most certain rule. Always be aware of the trading range before making any move. Let's get it started. Now let's get it started. So we're going to talk about the ranges. What is the ranges? I'm going to talk about a little bit about the core elements of the trading range. Then we're going to just dive into the liquidities inside and the range cycle. So what is a trading range? A trading range is a concept we use to understand where is the liquidity in our playground. I personally use that to understand where's my liquidity. And it's like a chessboard for me, right? So in the chessboard, you're going to have, without the chessboard, you can't play the chess. And without the range, I can't understand where's my liquidity, right? Because there's 1,000 liquidity in the, and once you open the chart, you're going to see 1,000 of the liquidities and you don't know which one to choose, which one going to get taken out. But the range is going to simplify this for us, right? So there is a phenomenon that consistently repeats what we call a trading range cycle. That gives us an edge. If you understand where we are in the cycle, you can easily approach the market with a high level of accuracy and understanding of directional bias. So also the ranges are so helpful in the market structure. So pretty much understanding trading range is a key, especially if you have strategy with the liquidity concept. Now, the trading range consists of multiple different pieces that we will eventually be blended off all of them together to create, let's say, the core. We call this the core elements. So let's just start with the bullish and bearish QMs, right? So the first core of the element trade at the trading range is the bullish and bearish QM. This is the basic. Maybe a lot of you guys know this. So the QM are what frame the trading range and is how we confirm when a range is formed. They are very easy to understand since we just only have 2 things to happen to identify them, right? So the bullish QM, we need to see a stop hunt to the downside and a break of market structure to upside. This is going to be a bullish QM. And in the bearish QM, we need to see a stop hunt to the upside and bearish QM and the bearish break of market structure to downside, which we call this a bearish QM, right? So this is the example of the bullish QM. See a stop hunt and a break of market structure right here. And this is a chart example. Take a look, price come, stop hunt, and we have a break of market structure to upside. So we call this a bullish QM. Now the bearish QM is going to be opposite. We have stop hunt and a break of market, stop hunt to the upside, break of market structure to downside. Take a look, price take out the liquidity here, stop hunt and a break of market structure. So we call this a bearish QM. Right. So now let's talk about the strong high and weak lows. At the beginning of the bearish trading range, now we want to learn what is the bearish trading range. We are going to see a strong high, otherwise known as a bearish QM. Okay. And pretty much at the end of the range, we're going to see a bearish trading range. We're going to see a bullish QM, otherwise known as, let's say, a weak low. So this is a strong high and this is a weak low. This is how the bearish range is going to form. At the top, you're going to see a bearish QM. At the down, you're going to see a bullish QM, right? So, and also this is an example, a clear example from this, stop hunt to the upside and break of market structure to the downside. So this is a bearish QM and a stop hunt to the downside, bullish break of market structure to upside. This is the bullish QM. So once you get the bearish QM falls first, and at the end you get the, let's say, the bullish QM, this is gonna create a bearish trading range for also stop on break of market structure, stop on break of market structure, strong high and a weak low. So this is the bearish trading range. Now I'm going to tell you where's the liquidities here, what we can expect, how we're going to approach this bearish trading range. Now, but before that, let's talk about the bullish trading range, which in this case, the bullish trading range is going to be opposite of the bearish trading range. At the first, we're going to see a break of market structure to downside, then break of market structure to the upside. So stop onto the downside, my bad, and a break of market structure to upside. So this is going to be a bullish QM, right? At the end, we're going to have the bearish QM. So this is going to be our strong low, and this is going to be our weak high. So this is going to be a bullish QM formation. And this is the example, bullish QM, bullish range. So this is going to be a bullish QM down here and a bearish QM, which we're going to form the strong low and a weak high or bullish trading range. Take a look. We have a stop hunt here and a break of market structure. This is going to create a strong low, and we have stop hunt and break of market structure to downside, which this is going to create the weak high. Now let's talk about the external range liquidity, right? Now that you understand the strong lows and a weak high, you will now able to understand what we call external range liquidity. For bullish trading range, let's say right now we're just talking about the bullish trading range. Okay, so the QM that formed the range are the external points. These are the external points right here. Okay, and so these became these are became the external range liquidity. In a bullish trading range, we are expecting, pay attention, we are expecting a new high to form like this. So the weak high here, this is the weak high, this is the strong low, right? So the weak high here is going to be our external range liquidity, the thing that we are expecting to get taken up, and our main liquidity right here, right? Let's take a look to example. Take a look. This is a bullish trading range, stop hunt, break of market structure, strong low, and a weak high. So in this case, in the bullish trading ranges, we are expecting to price take out to create a new high. So this weak high in bullish trading range, this is going to be external range liquidity point for us, right? And in the bearish trading range, right, it's going to be opposite. We are expecting to price create a new low. So the weak low here, this is the weak low in the bearish trading range, and this is the strong high. Okay, it's going to be our external range liquidity point. Okay, so this is going to be the weak low. It's going to be the external range liquidity for us in the bearish trading range. And this is the example. It's the bearish trading range here. Stop hunt break of market structure, stop hunt break of market structure, strong high, weak low. We are expecting to price create a new low by taking out this weak low as our external range liquidity. Right, now let's talk about the internal range liquidity. If we have an external range liquidity, then surely there is something called internal range liquidity. The internal range liquidity are the swing highs and swing lows inside of the trading range. And you guys know above each swing high and swing low in the market, okay, there is the buy stop and the sell stop orders, okay, which price, what price going to do? Take this up and reverse. Take this up and reverse. So that reason, between the strong low and weak high, or strong high and weak low, if you see a swing high and swing lows, those are going to be your internal liquidity. Basically, and the internal is the liquidity between the QMs and the strong high and the weak, the strong points and the weak points that you have, which is so important. It's going to make everything clear. Let me just show you one example right here. So this is the bullish trading range that we have, right? In the bullish trading ranges, okay, we have the strong low and the weak high. We know we have something that in the bullish trend, we have something here in the weak high that we call this external range liquidity point, right? So now between the strong low and the weak high, let's say the unswept swing lows, it's going to be our internal range liquidity. See, there is unswept swing low, internal range liquidity, unswept swing low, internal range liquidity, unswept swing low, internal, unswept swing low, internal. So, and in the bearish trading range, we have the strong high and we have the weak low, and we know we are expecting to price take create a, let's say, new low here. So the weak low gonna be our external point. Now take a look. Unswept swing highs are going to be our internal liquidity between the strong high and the weak low. So unswept swing high, unswept swing high, unswept swing highs, and unswept swing highs. Now, there is a formula that actually help you, which I call the safe internal range liquidity formula, which sometimes we have, as you can see, we have more than 2 liquidities. I mean, we have a lot of internal range liquidity points in the market, right? And we actually, I'm going to be honest with you, the market is not 100%, and we don't know which one going to get taken out by an institution market makers, right? Maybe price just gonna, the institution just take this internal right here, and then they swap up and go and take out the external liquidity, right? So we don't know actually 100% which one of these is going to get taken out. If you have a lot of internal liquidity points in the market, we don't know which one is going to get taken out, right? So that reason I have a simple formula for this, which I call the safe internal liquidity formula. Okay, so let's dive into that. So sometimes we see many internal liquidity inside the range, but price only take one or some of them and then reverse, okay, and go for the external. So, and leaves the rest untouched. The reason is simple. The market is not 100%. When there is a lot of liquidity, we don't know which internal liquidity are the important enough for institution and market makers to swap. This is where the safe internal liquidity formula comes in. The purpose of this formula, as I told you, is to help you to identify among many internal liquidity which one have the high probability of being swept so you can focus on it. Now, how to apply the formula is so simple. Once you define your range, mark all the internal liquidity. Start from the weak high or weak low and assign each internal liquidity a number, let's say. So this is a bullish trading range from the weak high, 1, 2, 3, 4. Okay. And after that, you're going to ask yourself, do internal number 1 and internal number 2 connect? That means these are, let's say, basically equal high or equal low. In this case, we're going to look for equal low. So yes, the 1 and 2, these are making the equal low. Cool. Awesome. Now, you're going to group them as a group A. Now, the 1 and 2, these are going to be group A. Okay. Now you're going to keep continue and you're going to say, is the group A make a connection with the internal liquidity number 3? So let's say, so the connection should be a trend line liquidity, right? So take a look. This is this is not, let's say, the trend line liquidity. Let me just clean this here. See, this is not trend line because this should get tapped here too. So on that cases, I'm going to stop and I'm going to take the last internal liquidity of the group A as my safe internal liquidity point. So the number 2 here for me is going to be safe internal liquidity point for me, right? So that doesn't mean that 3 and 4 doesn't going to get swept. That means at least you can expect institutional market makers take the second one and you can expect the reverse, or maybe price can come down, but at least you can understand this is a high probability of the liquidity zone. So take a look at the example, right? So this is the bearish trading range, a strong high and weak low. So we have 1, 2, 3, 4 internal liquidity. You're going to give them a number, right? You're going to give them a number, 1, 2, 3, 4. Okay. Now after that, you're going to ask yourself, is the 1 and 2 make it equal high? Yes. Group A. Is the group A make a, let's say, connection with the third one? No, this is not a trend line. This is not a trend line. So in this case, the last internal liquidity of the group A is going to be safe internal liquidity formula. So this is going to be our safe internal liquidity formula. Okay. So now if you take a look, this is the range. What we can see, price, take out the safe internal liquidity formula. This was the third one. Didn't take out the third one and create the new low and take out the external point. So as I told you, with this formula, you can easily understand which area is the higher probable, let's say, the liquidity area for you so you can take it. Now let's dive into the premium and a discount. Once we have our trading range identified, we can now implement what we call a premium and discount. In simple terms, discount is cheap and the premium is expensive. If you are thinking logically, it's more reasonable for you to want to buy something at the cheap price and sell something at the expensive price. The market works the same way. The only levels you will need here is 0, 0.5 and 1 of the Fibonacci to understand the premium discount. So let's say I have a phone. Let me just give you an example. Let's say this is my cover of the phone. Let's say I want to sell this, right? So if I want to sell this phone, I want to sell at the highest level of this phone market. So that's mean I want to sell it in a way to make a profit at the expensive price. If I want to buy this phone, I want to buy this phone as the cheapest level in the good condition phones in the market, right? So I want to buy it in the cheap one, okay? So to make profit in the both side, the goal is make profit. Once you want to buy this at the cheap, you want to just save some money on the market, right? And if you want to sell it expensive, you want to have a little bit more money on the, let's say, the thing to make a little bit profit on it. So the market is the same way. Now in the bearish trading range, the way we apply the premium and discount in our trading by measuring it from the high and low of the range. The 50% known as a equilibrium, above the 50% on the premium prices, which we call this expensive, and below the 50% is known as a discount prices or cheap. So in a bearish trading range, we only want to sell in the premium prices, and in the bullish trading range, we just only want to buy in the cheap price, or let's say the discount prices. Let me show you one example. This is the bullish trading range right here. So we want to buy it in the cheap prices. So you're going to draw the Fibonacci from here to here, and below the 50%, this is going to be the discount area. You want to just look for a buy here. And this is the bearish trading range. You want to sell in expensive. So you're going to draw Fibonacci from here to here, and you want to sell at the premium area above the 50% here, right? So now that you understand this, here is the trading range cycle come to play. We have now covered the basic core elements of the trading range, the QM, which represent either strong high and a weak low, strong low and a weak high, the external liquidity, which are the external points of the range, especially the weak high and weak low, since those are the targets to create a new high or new low. Internal liquidity, which are the highs and lows inside of the range. And lastly, let's say the premium and discount area, to know which area of the range we are looking to buy or sell from. So I teach you all of them by piece of piece. Now, if you put all of these together, we have something that's called the trading range cycle. So what is the trading range cycle? That's mean once you have the range, you're expecting to the first the internal get taken out, okay? Price, let's say in this case, come to the discount area, tap to the high time frame POI and go for the external point. So basically internal to the external point here and external to the internal point here. This is going to be your range cycle, okay? That's it. That means you're expecting the price take out the internal, come here to the discount, go for the external. In the bearish trading price, take out the internals, come to the high time frame POI in the, let's say, premium area and go for the external. Now, let's dive into the chart. And this was the PDF that I'm teaching to my one-on-one students for each concept. There's a lot of thing to learn. So now let's dive into the chart. I'm going to show you a live example in the market. So let me show you an example. So we're going to go with the bearish trading range here. What we can see in the 1 hour time frame, the medium time frame, what we can see price. We have a bearish QM here, stop hunt, and the break of market structure to the downside. And what I can see a stop hunt again and break of market structure here right to the upside. Okay, so basically, once I have the bullish QM, I'm the bearish QM and the bullish QM, that's mean a strong high and the weak low. Simple as that, right? So we have our bearish trading range. Now it's time to look for the internal points. The internal point is so important. So as I told you, the unswept swing highs, 1, 2, 3. So we have 3 swing points at basically internal points here, which, as I told you, once you have a lot of internal points, you can just go with the safe internal liquidity formula, which in this case, you can give them a number. So we can give them 1, 2, 3. And you're going to ask yourself, is the 1 and 2 making it equal high? Yes. Is the 1 and 2, which is going to be group A, making a trend line with the third one, which is not. So the last internal in the group A, which is going to be second one, which is, this is also, it's the Asia high, unswept Asia high. It's going to be our safe internal liquidity formula. So I like to add one safe. X for me is mean liquidity point here. Now what I'm going to do, I'm going to look for the high time frame points of interest. So we know we are just looking for the sell in the premium area. We want to sell an expensive. So I go to the 4-hour time frame. Now in the 4-hour time frame, above my, let's say, safe internal liquidity here, I have the order block right here. This is the order block right here that I have. Okay, so it's pretty much this big area, right? Which we can also refine this. So if I want to refine this, what I can see here, I can see the imbalance fill, it's match as the refinement. So I can go with the imbalance fill right here. Let's just go with this area. So this is my refinement, right? Now, basically, what I'm expecting is price come up, take out the, let's say, internal point, come to the premium area, tap to the high time frame POI. After this, I'm expecting to price go and take out my external point. But for now, I'm not just aiming for external point because this is the cycle and I should wait for each cycle, each pieces of the cycle to get happen. So right now, I'm not targeting my external liquidity. I'm waiting to price, take out my internal. Price engineering more liquidity here. As you can see, my internal get taken out. And after that, I can target my external point because I can understand price take out the internal, I'm going to go for external. Now I'm just going to look for my entry point, which for my entry point, I can enter here. It's depend, you can look for confirmation or any type of the entry and I can target my external point right here. So if I play this, price tap to the exact refine area. Just the day finished here and the new day open. And as you can see, making more liquidity and the way of external point. Okay, this is going to be my last target. And right now we are in the live market. So basically the volumes drop. We are about to go, we're about to pretty much finish the NY. So the volume is going to drop. But see, the logic behind the moves is all about the trading ranges. The trading range is going to open your eye, to understand, okay, why this move happen. So now if you open any time frame, any chart, okay, let's say any chart, this one, why this move happened here? Simple. You have a bearish QM, stop hunt break of, bullish QM, stop hunt break of market structure, strong low, and pretty much you have also stop hunt and a break of market structure right here. Basically, in these cases, I recommend to just take a weak high as a tree candle confirmation because this is a huge QM. And this is not going to be QM actually. This is going to be a liquidity. So just for this, let's say weak high and weak low, you can take those as a swing points. But for the strong low, strong high should be QM formation. And after that, you have 1, 2, 3, 4, 5 internal, right? So you can use the safe internal formula. So the 1, 2, 3, 4, 5. So these two make sense. And these two, it's not make sense with this one because if this was going to be trend line, this price should tap to here. So this is going to be my safe internal liquidity. See, that's going to be my safe internal liquidity. Okay. Now, if you go to the high time frame, like a weekly time frame, and also don't forget about the premium and discount, right? In this case, we want to sell in the discount area. So below this liquidity, the nearest POI that we have, it's right here. We have basically a resistant break to support. That's the nearest POI. Price tapped it and internal get taken out. Price go for the external. Again, show me another one. You can show me billions of the, let's say, price action, and I can easily simplify it for you, right? Let's go, I don't know, let's go, for example, to the gold. I catch a beautiful trade today on the gold. It made me, I think, around $2,000. And I'm going to create a the trade breakdown for you. So show me a price action here. Take a look. Why price went up? Because we was in the bullish market structure right here. Stop hunt and a break of market structure. This is the strong low and that's the weak high. Okay. And what you can see here is, see, this is, you can take as a QM stop hunt and a break of market structure. Stop hunt to the upside and break of market structure. Take a look. Basically, there's no T1 here. You should drop down to the forward time frame. But yeah, there is an internal point here in the 4-hour time frame. If you see, drop down to the 4-hour time frame to show it to you guys. Take a look. 1, 2, and that's it. And we have 1, 3. That's it. So follow the safe internal formula. These two are going to be your safe internal points. Okay, now I'm going to drop down to the high time frame to have a clear look. Take a look. We want to sell in the discount. Okay, we have the internal, the nearest PI below the internal. What do you have, my friend? You have this fair value gap right here, or imbalance fill right here. Price tap, take out this liquidity, tap to the high time frame PY, come to the discount area, and then went for the external point. That's it. Simple as that. You can look for sell, buy here, put the target as external point. Easy peasy. Right? So I hope you understand the range is going to make everything so much clear for you. The price action going to become clear because the ranges are the chess board. Well, we are here at the end of the video. I really hope you guys enjoyed it. If you want to learn directly from me one-on-one, don't forget to check out the link in the description. And if you have any question, if you want to ask any question, you can drop on the comment or you can message me on Instagram. I answer most of my DMs in Instagram, or you can just drop out the comment here, which I'll be going to respond to it. And yep, don't forget to like and subscribe. See you guys in the next video. Cheers.